Good to have you on the show. Tell me, how is it that you're analyzing both the domestic macro tailwinds that we have at our hands and headwinds and uncertainties globally? And how do you think the market is balancing both?
Good morning, everyone. Definitely, macro for India, domestic macros are really good. We have controlled fiscal deficit, controlled inflation, and CAD is also in favor. So I think RBI and government done a phenomenal job. And obviously, after 3-4 years of high growth, India is reaching a slightly sluggish growth for this year. Maybe from next year, you can think better growth. But in terms of certain sectors, we as a house continue to believe India's story is the capex-driven story. It starts with infrastructure, manufacturing, and then consumption, because manufacturing could be a big winner in this global reset change. And globally also things are a little uncertain, and every day things are changing. But as far as India, maybe short term there will be some hiccups, but in long run, medium to long run, India's story still hold very strong and positive view from our side as well, because we see structural trends coming out, like new sectors are emerging, like defense sector, which we never heard about this in majorly, like EMS, data centers, and followed by strong push on renewable energies. Railways also doing capex, specialty chemical. So all these capex someday, maybe next 2 years, will start reflecting in the revenues and profitability of the corporate world. And if you see the corporate world, again, their debt, everyone is reduced debt. So we are actually, as a country, light on basically taking leverages. So there is we still have a headroom for growth by leveraging it. And even rural consumption started picking up, better monsoons reflecting in recent prices and all. But I think we are heading for a good growth. Maybe worst is more or less behind us. After next 2 quarters, once we get a more clarity on global issues like tariff, setting at new tariffs and wars. So we next 2 quarters, after 2 quarters, we'll see a slightly good growth from India and stable. So as I highlighted, India is again entering a low GDP growth with a higher liquidity, and but certain sectors actually driving the growth stories, and these sectors are basically market leaders and the new sector, emerging sectors.
All right. Hi, Yogesh. Morning. This is Shrishti also joining in. That's about the factors at play for the Indian economy as a whole. But Yogesh, sectorally, help us understand what's your take on the banking space, and especially the public sector banking side, because of late we have seen a bit of an interest coming in back, and we also have that big QIP from one of the leaders. Help us analyze how do you sense the PSU banking space right now?
See, again, first of all, BFSI looks good, but we need to bifurcate it. One is again PSU and one is private banks. So on consumer banking, we think privates are better than PSUs, but valuations are very again attractive for PSUs. Is an individual call whether we are looking for only valuations, no growth, or you're looking for high growth and slightly ready to pay some premium. But as of now, if you ask me, considering the credit growth, every banks, including private and PSUs, can grow from here, and valuation looks reasonable for overall banking sector for me. And already RBI has given enough liquidity, so we also expecting some credit pickup in second half due to availability of liquidity and controlled inflation, and base is resetting again.
Okay, and Yogesh, hi, morning. In terms of your portfolio construct, where are you having the largest overweight in terms of the market cap? Are you playing it safe with large caps at the moment, or does the conviction on the broader end still continue?
See, as a house, definitely different funds have a different weightages of large, mid, and small cap. But we trying where the growth, we are actually focusing on the quality and earning growth. So where you get earning growth coming from the emerging sectors and new sectors, and these are the major sectors are only available, or leaders of these sectors only available in small and mid caps. So we are selectively overweight on small and mid cap because we see it next 3 to 5 year trend is very good, and these are the structural trend which we think is irreversible, like data center, defense, exports, power sector is already picked. Majority of the capital goods companies available only in small and mid cap sector. So we are again, if you follow the earning growth, definitely your allocation to small and mid cap could be higher, but it's also depend on fund to fund. But overall basis, across the funds were higher on small and mid caps because opportunity and earning growth today is only available in these segments.
All right, but Yogesh, given the fact that there's a lot of sectors churning underway, help us analyze that which sectors do you believe may not participate much going on in the upcycle for the markets, if at all? Which sectors do you believe can be lagging behind?
Very difficult to point out, but what our understanding is, due to this tariff, if let's take a bigger export countries like China or maybe some other country where the commodity like product like commodity chemical or commodities, they are in surplus capacity. So as of now we are avoiding, but I'm not is also depend on the sector to end sector and company to company. But these are the certain products we are avoiding, and where the competition is very high, capacity is also excess, and like where trade boundaries are not very clear actually in terms of global, and where anywhere where we see imports are there, it is not restricted to only commodity chemical or metals. It is in everything, maybe certainly in building material, including pipes also, polymer also, whatever is. We are also threat of higher imports or global prices will again collapse due to this overcapacity, because let's take a US is imposing higher tariff on China. So definitely that product has to go somewhere, because approximately China export around $1 trillion worth of goods. So if they impose more on that, so definitely China need to compensate their trade in some other geographies or in India. So those are the trade we are slightly cautious. Difficult to comment on company specific or product specific, because there China exports a lot of things. But one thing is very sure, India growing up in basically specialty chemical, CDMO business, defense export, and for domestic data center looks good actually.
Okay. So other than domestic data centers, where is it that you deploy all the monthly fresh inflows that you get into your schemes?
See, it's we spread between, let's say, consumer, because consumer sector is not done well in last 2-3 years. So we do see some green shoots in rural economy, because there is a positivity in real. There is an increase in real rural wage growth. So we do see next 1 or 2 quarter things will pick up in consumer sector. So we are slightly increase our allocation in consumer sector at this point of time, and certainly BFSI selectively, that includes your NBFC and certain banks also. So slowly we have become not exactly overweight, but increasing weight in BFSI and consumer due to last 3 years of underperformance and improvement in ground level checks, and obviously RBI given enough liquidity to grow consumption and improvement in banking sector.
Interesting. Okay, Yogesh, great to have you on the show. Thanks for joining in with your thoughts today.
Thank you very much.
Okay, let's just revisit where the market has settled in at before we take that break.